Second in Africa Adaptation Dialogue series to co-create solutions for COP27, scheduled throughout this month. Before we begin, a quick run through the housekeeping rules. This event is being translated in French, so on your Zoom call, you will see a globe icon. If you click on it, you will be able to choose the language of your preference. And also, we really want to make this dialogue we really want to hear from everybody. So if you can really post all your questions on the Q&A box and not on the chat box, you can use the chat box to introduce yourself or talk more specifically on the subject, but please do use the Q&A box for all your questions. Without any further delay, I welcome Anthony Nyong, the Regional Director of GCA and the Chair for this dialogue. Over to you, Tony.
Thank you very much, Priya, and thanks everyone, thanks colleagues for joining this very important session. We all know that climate change is undoubtedly one of the major threats, if not the greatest threat facing humanity today. We largely got here because we chose a development model that has proven to be very unsustainable. The impacts of climate change are felt more among poor developing communities on the front line, who have neither the means nor the wherewithal to defend themselves. Africa is indeed on the front line. While the world is speeding towards reaching a net zero world by 2050, the recently released IPCC report acknowledges that the amount of CO2 in the atmosphere is enough to continue to create havoc for Africa in the next 2 decades, even if we achieve this zero emission economy. Africa therefore needs to adapt and build resilience to climate change. The Global Center on Adaptation, as a global solutions broker, has teamed up with the African Development Bank to establish the Africa Adaptation Acceleration Program to mobilize $25 billion by 2025 to scale up and accelerate adaptation in Africa. This is exactly what the continent needs. Africa's leadership has also endorsed this program as Africa's plan for adaptation. This plan consists of 4 bold ideas to build resilience in and modernize agriculture. 1, mainstream resilience into Africa's infrastructure, focusing on nature-based solutions. 3, investing in job creation and building entrepreneurs among Africa's youth. And 4, mobilizing resources from innovative sources to drive this agenda. The activities around these bold ideas are based on scientific evidence generated in our annual State and Trends in Adaptation report. Last year's report did not just present stories of woes or challenges, but also provided solutions and opportunities. I wish to thank the UK government in its capacity as COP presidency for supporting dialogues that bring people together to elaborate solutions and address adaptation gaps within these 4 bold ideas. The first dialogue was on transforming agriculture. The second dialogue is on transforming adaptation finance. My name is Anthony Nyong, and I'm the Senior Director for the Africa region at the Global Center on Adaptation. I will be chairing this session. One of the biggest challenges often cited when it comes to implementing adaptation and resilience issues is the limited access to finance for Africa. The current adaptation flow to Africa is insufficient to meet growing adaptation needs. For 2017 and 2018, only about 6 billion was tracked as adaptation finance in Africa compared to the needs of about 33 billion. There are many sources of finance out there, yet unaccessed by Africa. How can we bring these sources on board? We have assembled here the best of the best to discuss the needed solutions to upscaling adaptation finance in Africa. Please allow me to introduce first our framing speaker, Ms. Bella Tonkonogi, who will basically let us know what will be the key issues, what are the key issues that we need to surmount to be able to address the adaptation gap that we have. Bella Tongono leads CPI's US-based team. CPI is the climate policy initiative, including guiding and overseeing the team's technical work in climate finance and leading external engagement and program development. Others that will join this panel include Mr. Jean-Paul Adam, who is the Director for Technology, Climate Change, and Natural Resource Management in the United Nations Economic Commission for Africa. Prior to taking on this role, he served in the government of Seychelles in several capacities as Minister of Health, Minister of Finance, Trade and Blue Economy, and as Minister of Foreign Affairs. He is well known for his work in driving the negotiations towards debt for climate change adaptation swap, and also launched the process for Seychelles to become the first issuer of a blue bond anywhere. Like I told you, we have a very rich team. We also have Dr. Nicola Ranger, who is the head of Sustainable Finance for Development at the Oxford Sustainable Finance Initiative. Dr. Nicola Ranger is the head of Sustainable Finance Research, like I've said, for development at the Oxford Sustainable Finance Group of the Smith School of Enterprise and the Environment at the University of Oxford. Nicola is also the Deputy Director of the UK Centre for Greening Finance and Investment, established by the UK Research and Innovation in 2021 as the National Centre to accelerate the adoption and use of climate and environment data and analytics by financial institutions internationally. Then I have the privilege of also introducing Dr. Rametal, who is a senior adaptation and resilience specialist in the climate change group of the World Bank. Before joining the bank in 2017, she worked for 15 years in climate adaptation and development, holding senior positions with the World Meteorological Organization, the CGIAR Research Program on Climate Change, Agriculture, and Food Security, and the Red Cross Red Crescent Climate Center. I also have the privilege of introducing our next, one of the other speakers, Mr. Julius Ngoma, who is the National Coordinator for Civil Society Network on Climate Change and has been leading the network since 2014 on the major strategic areas of policy research and advocacy, capacity building, and information management, networking coordination and collaboration, and fundraising and resource mobilization. Last but not the least is Ms. Davina Milenje-Uela, who is a Principal Program Coordinator at the African Development Bank. She currently coordinates several special initiatives within the Climate Change and Green Growth Department of the African Development Bank Group, including the Africa Nationally Determined Contributions Hub, a platform hosted by the African Development Bank to support African countries to implement their Paris Agreement climate commitments. She also coordinates the Financial Alliance on Climate Change, an initiative launched by the African Development Bank to mobilize, catalyze, and leverage domestic climate finance. And she also coordinates the bank's circular economy program. So, like I said, we have a very rich list. And without wasting much time, I now invite our framing speaker, Bella, to please speak to us. Thank you.
Thank you so much, Tony. It's really just a huge pleasure to be here, and has been a great pleasure and honor for us at CPI to work with the team at GCA on adaptation finance over the last couple of years. Let me check before I begin that you can see my slides.
Yes, we can. I can.
Great, wonderful. So my organization, CPI, we're an analysis and advisory nonprofit organization. And for the last decade, we've been delivering the most comprehensive assessment of climate finance flows, which is used by policymakers around the world. We also work to understand the effectiveness of climate finance investments and to develop transformative solutions to deliver climate finance at scale. And so we were really pleased last year to work with GCA to develop a more detailed picture of adaptation finance flows and possible solutions in Africa. And I'm really pleased to tell you a little bit about what we learned today. So let me start by giving a big picture around global climate finance flows. And you'll hear me, and I apologize for this, I had to switch between talking about sub-Saharan Africa and MENA, Middle East, North Africa separately, and Africa as a continent. And this is just a function of how our data is received. Much of it is received as sub-Saharan Africa and Middle East, North Africa. So it's so some of our data is presented in that way and others as Africa as a continent. So let me just start by saying first that sub-Saharan Africa is the destination for just 3% of global climate finance. Most climate finance globally flows to and within advanced economies, Western Europe, US, Canada, as well as China, with developing economies receiving relatively little. And you can see on this map the total flows we've counted for 2019 and 2020. In aggregate, there's $632 billion, with $19 billion for sub-Saharan Africa and $16 billion going to Middle East, North Africa. Now, the top 10 most vulnerable countries to the impacts of climate change are all in sub-Saharan Africa. And so for international finance, so this is public finance going from multilateral financial institutions, climate funds, donor countries. For adaptation, it's somewhat heartening that sub-Saharan Africa receives the greater percentage, about 25% of those flows. Those are the lighter orange boxes in this chart, while the red ones are domestic adaptation finance. So sub-Saharan Africa is receiving, sort of on a percentage basis, the greater percentage of international adaptation finance flows. The majority of adaptation finance across Africa, now looking at the whole of the continent, we have counted a total of $7.9 billion of adaptation finance that annually. That is mostly international public finance. And what we see is that across all of the regions, the water and agriculture sectors are the primary or the majority of the destination sectors for adaptation finance, which makes a lot of sense. Of course, those are the sectors that are highly vulnerable to climate change and also make up a bulk or a large part of economic activity, in particular the agriculture sector. And you can see in this chart some other kind of regional differences. In particular, something perhaps also obvious is that in North Africa, the water is the majority of the destination for adaptation finance, so the water sector, whereas in most of the other regions, the agriculture sector predominates over water. Lastly, just on data, I just want to zoom out one more time and just say, I think that what we've been seeing is that the adaptation finance is growing momentum around the world. And this is pretty clear in the graph where you see adaptation finance globally going from $30 billion when we counted it in 2017, 2018, to $46 billion in 2019, 2020. So it's a 50%, slightly more than 50% increase. So we are seeing adaptation finance gaining momentum. That's true across the globe. But no matter how you count it or what you count, we still see that adaptation finance falls well short of estimated annual needs through to 2020. And when we look at this chart, it's really clear that incremental changes, so going 50% or 25% increases every year, are not going to get us to where we need to be, that we need a step change. And that really requires a multi-pronged approach to really addressing the investment gap. So when we think about this kind of approach, how do you actually drive investment to address that finance gap? We've come up with 3 broad approaches that really all need to be used in concert. The first is around mainstreaming into investment decision-making. Adaptation is different from mitigation. It's about adapting your activities, your investments, to be resilient for climate impacts. So for each investment a financial institution makes or a budget that a government makes, you need to screen that investment to understand, is it at risk for climate change, and what are the potential solutions? Now, every financial institution and government needs to be doing this, and it needs to be doing it in individual investments as well as broader budget and investment plans and strategies. And that includes COVID recovery packages and other kind of big packages of funding. The second is around enabling environment. There are kind of 2 buckets here. One are climate adaptation specific activities that need to be supported. Things like developing national adaptation plans that help us understand the kinds of investments that need to be made, or improving access to climate data, mandating disclosure of climate risks so that companies understand what their climate risks are, and investors understand what the risks of those companies are. And then there are things related to the macro environment that are connected to an impact on resilience. Issues like debt sustainability or investment environment, city creditworthiness, that need to be tackled at the same time as those climate-specific concerns to allow for more investment. And then lastly is deployment of innovative finance. And you notice I didn't start here, as this is not a silver bullet. Finance is not going to solve all our problems, but it can help, and especially can help demonstrate very tangibly the solutions. And in deploying innovative finance, context matters. We need to know what specific investment barriers we're trying to solve for. And lastly, there is an enormous opportunity within innovative finance, not just in supporting those adapted investments, so the investments to make a piece of an infrastructure project more resilient, but also in supporting those companies, the SMEs that are enabling adaptation solutions to be implemented. Companies delivering risk assessment services, climate data, drought-resistant seeds, cold storage solutions, all of those can really help us globally and within Africa as well, of course, really drive adaptation solutions and really help to bring adaptation finance really to the fore. So let me just conclude with a case, just a story about what adaptation finance is, to make it as concrete as possible for everyone. Now, Kamaza is a company in Kenya I worked with a couple of years ago to help them come up with a solution to scale their company. They're a microforestry company working with thousands of farmers in coastal Kenya to plant and grow trees, to restore the land and provide income diversification to smallholders. And as we all know, trees take a long time to grow. So Kamaza came up with a financing idea to allow them to sell the future income from trees sooner, to be able to plant more and scale up their company and reach more people and have more adaptation impact. They're now getting ready to launch this vehicle. It's called the Smallholder Forestry Vehicle, and it's one of the most innovative solutions we've come across as part of a lab that we run called the Global Innovation Lab for Climate Finance. So adaptation and adaptation finance are really about delivering solutions to help people become more resilient. I'm really looking forward to today's discussion to dive into the details of what that means in practice. So thank you very much, and thank you so much for the opportunity to present some framing thoughts today.
Thank you very much, Bella. That was wonderful. And we really know that we're going to have a very interesting session today. I have the pleasure of also inviting to speak Mr. John Paul Adam. Like I've said, he's basically been the person that drove the first debt for climate swap on the continent. But it's not just going to talk about that. There are several innovative financing mechanisms out there that have been tried elsewhere or tried in other parts of Africa and are yet to upscale. Can you give some of those initiatives and what it would actually take to upscale or to accelerate some of those initiatives on the African continent?
Thank you very much, Tony, and thank you, Bella. I think that was a really fantastic presentation. It really outlines the challenges, but also potentially some opportunities, which is perhaps the direction that I would like to go. So, firstly, I think we need to recognize, first of all, the need for upscaling the financing that is available, particularly for adaptation, where we expect that on a target of 2 degrees Celsius, we want to have a target that's below, but we're currently at a rate of warming that's above 2 degrees. The cost to adapt will be, just to adapt will be over $50 billion per year. And the African Development Bank has pointed out that investments are required of over 3 trillion in both mitigation and in adaptation to implement the nationally determined contributions. And this is framed against a situation where African countries are almost on a daily basis losing income due to the impact of climate change. The work that the African Climate Policy Center, which is based in UNECA, has done has shown that for every 2 degrees of warming above pre-industrial levels, Africa loses about 5% of GDP. And the level of warming that we are heading for now means that on average, African countries will be losing by 2030 well above 5% of GDP. And in some regions, because unfortunately warming is not uniform, you will have even greater losses. In the Sahel, it's expected to be almost up to 15% of GDP. So we have some huge challenges to address in terms of increasing that overall amount of finance. The other point that I would just make at the outset is the big challenge has been to direct money into adaptation, but we believe certainly that we should not have necessarily a firm division between adaptation and mitigation. And certainly in Africa, when we look at a lot of the adaptation projects, there are opportunities to address both issues simultaneously. And we think it's very important that we keep this in mind. The other just framing point that I will make relating to the mobilization of resources is that we have seen in the context of COVID-19 how much resources can actually be mobilized. We've seen over $20 trillion being mobilized since the outset of the pandemic to fight COVID-19. But unfortunately, the method of distribution remains fundamentally unequal. In low-income countries, the spend per capita on COVID-19 was only $57. And among low-income countries, around 2/3 of those are in Africa, contrasted with advanced economies where the spend was in excess of $11,000. So what are the ways in which we'll address this? Firstly, we do have to point out that African countries must continue to emphasize and advocate for mobilization of resources beyond the 100 billion. The resources required are trillions. We need to define that a little bit more clearly. And we also need to break down the sources of those financing, because currently everything is grouped together, whether they be grants, soft loans, or private sector investment. Having a breakdown will allow more transparency, and we have seen questions being asked, for example, by Oxfam about the OECD figures, whether the 79 billion which has been mobilized, how much impact is this really having? And I think breaking down those figures is going to be important. In terms of opportunities for innovative forms of financing, one area that we are looking at in the ECA is debt for climate adaptation swaps. And I have some personal experience in that, having led the Seychelles debt for adaptation swap in 2015. In a debt for adaptation swap, it's essentially about identifying a portion of debt which is at an expensive rate, and then refinancing it using potentially different types of mechanisms. In the context of Seychelles, we got a small discount. It was only 5% of the debt, which was cut off what's called a haircut by our creditors in the Paris Club. But the majority of the benefit was achieved by getting cheaper financing. We got financing from the Nature Conservancy, which is an NGO, at about half the interest rate than what we were paying to some of the commercial creditors, bought back the debt, and then converted the debt into local currency to pay back through a special purpose vehicle, the Nature Conservancy. And the commitment that Seychelles made was that all of the savings would be invested in climate adaptation. And in the context of Seychelles in particular, on climate adaptation through the creation of marine protected areas. So these kind of models are also interesting for other African countries that may have high levels of debt. We're currently working with some West African countries, in particular Cabo Verde, and they have entered into discussions with the government of Portugal about potentially refinancing a portion of their debt, possibly with a haircut, and possibly also by refinancing through a new bond at cheaper rates. Senegal is also interested, although they do not have a very high level of debt. The point of debt for adaptation swaps is not just as a means of reducing your overall debt burden, but about refinancing current debt, which may be expensive. This will be particularly important because African countries are expected to pay 7% of GDP in debt repayments over 2022, and it's expected to be as high in 2023. In addition to debt for climate adaptation swaps, there's also a big opportunity to get more private sector investment into Africa. And a lot of the time, the opportunity is through bond issuances. Africa and the Middle East combined currently issue less than 1% of global green bond issuances. So as was illustrated very well in the presentation from Bella, Africa is getting quite a good share of adaptation finance through official sources. But we will always be lagging behind if we cannot properly tap into the opportunity from the private sector. And we've seen in Asia how green bond issuances have been particularly useful. There are some positive examples from Latin America and the Caribbean. There are only a few examples in Africa. Seychelles issued its blue bond in 2018. And this was aimed at, and it was a relatively small amount. The lower interest rate was achieved by blending with grant-based resources which were available from the GEF, and also with a partial guarantee that was available from the World Bank. So there are opportunities for African countries to go down this route. Some countries may find it interesting to issue green bonds on the basis of the strength of their economy. South Africa did so last year to refinance investments in their renewable energy sector. There are opportunities for also looking at adaptation type investments with green bonds, particularly looking at the performance indicators and the impact that these can have in terms of reducing disaster risks, and also looking at sectors like agriculture, where it has been difficult to channel financing to small and medium enterprises and smallholder agricultural producers, for example. And in Rwanda, they have a very interesting proposal precisely to develop a green bond which will help channel financing through on-lending to small-scale agricultural producers. The Economic Commission for Africa has also worked on a liquidity and sustainability facility, which we launched at COP26, which aims to further stimulate the private market for what are called for the repo market or repurchasing market, which hopefully will stimulate the demand for African bonds. And the focus is also that to benefit from this facility, they will have to be bonds that are linked to climate outcomes or to outcomes that are consistent with the achievement of the Sustainable Development Goals. So this facility will, alongside other actions, hopefully stimulate more private sector investment for African countries. Just a few final points to conclude. There is also a big opportunity in Africa based on the conclusion of Article 6 negotiations in Glasgow for the development of a properly developmental carbon market in Africa. If we can get good levels of a good price for carbon on the continent, we're looking at least $50 per ton. This can generate significant additional resources, which can be paired with other financial innovations, such as the issuance of bonds, to channel investment into critical areas of adaptation. And the final point would be just to mention that there's also the Alliance for Natural Capital in Africa, which is one of the means by which we hope to, the African Natural Capital Alliance, which hopes to encourage investors on the continent and the financial institutions on the continent to channel more of their financing into adaptation-related projects and therefore boost resilience across the continent. Thanks so much, Tony.
Tony, you are unmuted.
Tony, you're muted.
Thank you. Thank you so very much, Jean-Paul. You've presented some innovations based on the opportunities that Bella talked about in her presentation. We constantly are depending on public sources. When you look at our finance flows, it's from government, NGOs, things like that to the others. The private sector is really not playing much in that space. And the last statistics I saw was that we expect the private sector to account for about 75% of all climate finance, but thus far, only about 3% of private sector flows actually address issues of climate change, particularly adaptation. So I think that brings me to Nicola Ranger. What are the main constraints to mainstreaming investment to mainstreaming resilience into investment decisions? And what do you propose? What do you think we could do to address some of those impediments, either in terms of the instruments we have to create or in terms of the policy, anything? Just what do we need to do?
Thank you very much, Tony, and hello, everyone. It's a pleasure to be here today. So I guess building on Jean-Paul's excellent presentation, I'm going to talk about not innovative finance. So basic financing, how do we get finance to be flowing into adaptation and resilience in Africa? And why is this important? So why is it important that we think about the broader financial system and leveraging that finance? Well, one is obviously just scale. So if you think now, total assets under management in Africa are doubling in this 10-year period to 1.6 trillion. So what if we can get those additional trillions of assets to be aligned with adaptation and resilience goals? That's really a key focus of our work and also a number of people's work around the world. In addition to scale, the way that I think about this is that if you take, for example, just infrastructure finance, so all infrastructure finance is about 60 times greater than adaptation finance. So I think we have a potential problem at the moment in that we have growing adaptation finance supporting resilience in Africa and other parts of the world. But at the same time, we have finance flowing in the other direction, which is potentially not resilient and is supporting growth in ways that are potentially maladaptive, flowing in the other direction. So I think a key focus now, in addition to the wonderful things that we've heard on the innovative finance side and adaptation finance, is to get those core global financial flows really supporting adaptation and resilience. And one of the things I was very disappointed, I guess, to see at COP26, and I know we're meant to be being positive, is that we saw this 106 trillion in assets being aligned to net zero. And lots of discussion about Paris alignment. But Paris alignment means aligning with climate resilient development as well. So what I would love to see for COP27 is a similar goal of aligning assets with climate resilient development on a similar scale. So that's my first point, and that's the point about the scale of the opportunity and also the massive need to align finance with adaptation and resilience to support the goals. My second point is around policy and so the frameworks that we need to get there. So we've talked about public finance, and public finance can play a really important role in helping to leverage finance into climate resilience. But there are other things that we need policy to do. So one is and this comes back to the point that Bella made, setting the right policy goals and adaptation goals. So at the moment, a challenge that we hear from many investors is that they don't actually know where to start on adaptation resilience. So we need those goals and plans to be made clear by public policymakers so that investors can begin to align their finance with those goals. And then the other part on the policy side is the financial regulatory environment across Africa. So ensuring that is conducive to supporting investment in adaptation and resilience. And that can be sort of core sort of investment environment regulations, but also, potentially think about how can you bring in disclosure incentives to actually incentivize finance into adaptation resilience. And then the final point that I would like to make about one of the gaps is on the data side. So we talk a lot about data and that being a constraint. I don't think it is a constraint. I think actually we have the data that we need, but the key thing is making that open and available and relevant to all. I'm involved with a number of other organizations in an initiative called the Global Resilience Index Initiative. And this is really about trying to create a common language of risk, a common currency to discuss risk between investors, with governments, with communities, so that you can begin to design investments that are fully aligned with resilience goals. So just to conclude then with those three brief points around this alignment of finance, the need for the important role of public policy and the important role of data and the opportunities there, but also this goal that to see by COP27 a similar momentum on aligning finance with climate resilient development that we've seen on net zero. This will have a huge impact globally if we can do this, and it's very much achievable. And I'll finish there. Thank you very much.
Thank you very much. Like I've said, this is an interesting panel, that things like policy changes, would really drive this agenda in a very strong manner, and I have the privilege of inviting Arameto to please take the floor. And Arame, you will be able to share with us an example on building incentives for adaptation investments. Because sometimes we talk about these things and they look like as if they are not real. We've just heard from our colleague Nicola. People sometimes wonder, what should we do? How can we invest in adaptation? After COP26, several development partners came to us and said, yes, you guys talk about adaptation, but what exactly should we be financing? What should we be doing? And so on. So that to them became an issue. So maybe you can share with us, an example on building incentives for adaptation investments, and what role do you think that development institutions like the World Bank can play here? Yeah, Rame?
Thank you. Thank you very much, Tony, and thanks to colleagues for the excellent comments that have preceded. The truth of the matter is that we have not yet seen enough examples of private investment in adaptation. And I think after a couple of years of asking ourselves that question around COPs in our multiple fora, I think it's important to maybe ask, why is it that adaptation investment from the private sector is not forthcoming? And what are tenacious, very obstinate barriers which are preventing that from happening? So we've asked ourselves that question recently. In 2021, I was the lead author on a bank report that focused on enabling private sector investment in adaptation. So Tony, I won't answer your question, unfortunately, with exact examples, because those are still not forthcoming. We have a few cases. Actually, the report summarized about a dozen across the globe. 3 of them were in Africa, mostly centered around insurance, which, as I say, is always important, but not the silver bullet that we would like to focus on. But what I'd like to mostly highlight in this panel are the barriers which are still in front of us. I think Nicola put her hand on them very, very eloquently, we still don't really know. What is it that countries have to adapt to? I think we've got NAPs, which are increasingly high quality. I need to commend many of the African governments that are now getting to NAP implementation plans as part of their NDCs. So I think that's brilliant, but we still don't see the dollar tag associated with implementing those national adaptation plans and programs. While an investor who comes to a given country, let me pick on the one that I cover these days, Burundi, one of the world's poorest countries in Africa. You come to Burundi, you want to invest in adaptation. Where's the investment plan? So I think as we go to COP27, if there's one message, Tony, which I would love the GCA to echo, it would be to ensure that every single African nation has an investment plan for adaptation. In the blueprint which we've come up with, that's step 2. Assuming that countries have already begun some process of defining their adaptation needs, at step 2 of this blueprint, we do need to start seeing, and quite urgently, African nations having a very clear assessment of their capital investment needs to implement adaptation. And it can be imperfect, it can be incomplete, but I mean, we've got to start with some sort of an investment plan saying, hey, to achieve climate resilience across the key priority vulnerable sectors to adapt to climate, this is what needs to be mobilized. And then only at that stage do we have a basis for moving to what we call step 3, saying, all right, this is the portion of that investment plan that can be supported using concessional finance from MDBs, among other sources. The Green Climate Fund is another one. And this is the other portion where we actually see a potential for attracting private capital. And again, why is it that private investors put $1 to any initiative, be it adaptation or traditional finance? Back to Nicola's point, I believe it's because they make a profit out of it. So we also need to lose the perception that all adaptation has to be publicly financed. I think some examples are emerging where we see that a profit can be made, and that's where we attract the private sector. That's where we say, let's make sure that some of these initiatives where a buck can be made are actually supported using private finance, with the assumption, back to Bella's point, that public finance alone will not suffice to foot the adaptation bill that many of our countries are facing. That process is still very at its early stages, let's put it that way. Looking at steps 3 and 4, I think we only have a couple of examples out of Africa where we see projects, adaptation projects that deliver high adaptation dividends, structured in a way that enables private investment to come. And what we find is that blockages are often regulatory, we mentioned those earlier, but they're also with the actual structuring. If it's a PPP, there needs to be a very limpid PPP framework, one that allows by law the structuring of the program to attract private investors and ensure there's guarantees for their return on investment. So I insist on this structuring of the project, which often also will require increased capacity within our ministries of finance to enable that private portion of our adaptation financing to be picked up by private investors. The good news is that private investors often will be the first to mention what those blocks are. And I would always recommend any country that goes that route and is at stage 3 of this blueprint to invite private partners on board early into the process rather than downstream, so that we have this exchange of thoughts and good practice between public and private financiers to ensure that the pipeline is indeed supported to the extent possible. And then the 4th step in this blueprint, which you've put out, Tony and colleagues, focuses on actually ensuring that the investment that's identified with the potential for private support is actually prepared to make it to market. And often there, I see a role for continued support from our public institutions, MDBs, government, and even NGOs to ensure that here we provide that missing middle bit that consists of supporting a project to be structured, to be appealing, and to make it to investors. So that we can actually get to the last stage of this blueprint where we deliver an actual deal, where a private investor is able to put money to adaptation. And as I said, we've seen it in Africa a lot in insurance. We've also seen it in the delivery of adaptation services. And I'm thinking here through the plethora of climate services, which are now privately developed and delivered. but those often tend to happen in isolation. They don't happen with the green light or stamp of approval of governments. And I think taking a step back, it's quite important upstream into this blueprint to have governments really play a role in attracting private investment in their adaptation agenda, not to shy away from it, not to think it's some sort of an unwelcome source of financing. But I think without that, we don't get very far in footing the adaptation bill, which is increasingly high. Looking at Africa. I'll stop there, but happy to answer questions later. Thanks again, Tony, for having me.
Thank you very much, Arame. This is quite good. I agree with you. If you don't have a plan, you don't have a strategy, there's really nothing you can do about it. And I think we'll take that suggestion further, that to really drive adaptation, African countries should have an investment plan going forward. We don't have much time left, but I'm going to switch the order. I'll first take Davina, because this is so that we don't break that chain of thoughts. We have financial institutions on the continent. They sit on a lot of liquidity, the pension funds, the sovereign wealth funds, the commercial banks, and so on. Why are they or not investing in resilience or adaptation? What is it that can be done to unlock that important source of money for private sector investments in Africa? Then after that, I'll come to you and Julius to wrap it all up from the perspective of the civil society. Yeah, Davina? Okay.
Yeah, thanks, Tony. Indeed, several of the speakers have pointed out really pertinent issues on why we still see 3% of adaptation as adaptation finance as flows to the continent. And to your question in terms of private sector flows, I think Alama mentioned it, that when there's an opportunity, the private sector knows. Nicola also talked about the issue being them not understanding what is it that is adaptation. Now, the issue has been matrix and understanding the reward system in adaptation. What we've tried to do at the bank is to prove that they can be, even at the bottom on the smaller scale interventions, to try pilot adaptation value chains, if I may call it that, to find a way that the private sector can be brought into financing adaptation. And this, we are piloting what we call the adaptation benefit mechanism to really respond to two critical issues. One being access to finance, which we've really talked about, and of course, the shortage of verified information and metrics related to the added value. The adaptation benefit mechanism is designed in a similar way that the carbon markets in the CDM worked. That way, the idea is if the CDM on the mitigation benefits was able to mobilize billions of finance very quickly, there is an opportunity and understanding that that was because a ton of carbon was able to be measured. If we could find a way of understanding a unit of that adaptation measure, then it would make sense for the private sector to get involved. So what we've done with that in the 5-year piloting, which started 2 years ago, is to reach out to firms that are already involved in adaptation. We have, for instance, a company in Lagos that is working on flood protection in a community, working or developing portable dams around those communities. It's a Dutch private sector company that is piloting this. We also have with the cocoa farmers in Cote d'Ivoire, in collaboration with the International Agroforestry Center, ACRAF, to work out how to measure the benefits in terms of irrigation and support to the smaller farmer communities in Cote d'Ivoire. The idea is that when this works and we are able to define the benefit for the private sector, then we would deploy it. We're looking at 4 more projects in Benin, Burkina Faso, and Congo in collaboration with GIZ to see how that mechanism can be rolled out or scaled up, I might say. This is what we are also doing is working, especially on the transparency issues, to creating an ABM, the Adaptation Benefit Methodology panel, which would look into the validation and verification and the approval system of the units that are generated. So that is a part of the work that we're doing around the evaluating of the adaptation benefit units that could be part of the Article 6 non-market mechanisms. So the other area we're looking at is on the bond issuance. I think there was mention around the resilience bonds. And so one of the areas, and of course, as a bank, we have had good success, I might say, in terms of the issuance of the green and social bonds. We currently have issued close to 10 billion of both social and green bonds. And these give us a good indication that with good pipeline, there is interest from private sector to generate resources that can be invested in these projects. So with the bond that would look into nature-based solutions, my colleagues in the department are working on a parks bond as natural parks, and this would work around generating revenues for African nature parks to generate a new flow of funding from institutional investors and the private sector. These are all hope that we would have at least a feasibility study on these bonds by COP27. But generally, so to speak, we have a lot of confidence that once we have the metrics right, we have information flowing to the private sector, most of it de-risking information, we would be able to blend the different instruments that we work with to be able to mobilize funding for adaptation mechanisms. So I'll stop here and happy to answer any questions. Thank you.
Thank you very much. We're really running very low on time. Julius, we hear these big numbers. They look small to us, but they're big to the people on the ground. Is adaptation finance reaching the people you work with on the ground? What more needs to be done?
So hi, Anthony, and thank you for giving me the opportunity to speak on behalf of the civil society. And I must say, listening to the presentations and also to all the suggestions by the colleagues, the previous panelists, I must say that I agree with the following. There are limits to adaptation. The financing needs for adaptation are higher and are getting higher, and that is making it even life more difficult for the communities. I must also say that even effective adaptation cannot prevent losses and damages. So whatever the case, we also need to watch the residue part of the issue, but also increases in average temperatures beyond 1.5 will make adaptation difficult and more costly as we go beyond. So on the question, I have a few points. Of course, some of those might resonate on what the colleagues have indicated, but also just to emphasize on the fact that the high cost for adaptation versus the low levels of resources being mobilized locally and internationally is actually making it more difficult for communities to adapt. Not only for communities, but also for civil society to play their role in terms of supporting the communities out there. And you also mentioned when we were actually introducing the issue of access to finance. I think the difficulty is to access the adaptation finance by the civil society and other players on the ground to directly support a concrete adaptation action is actually making it more difficult. And I think this is something that needs to be looked at. And if we want to actually make sure that we are accelerating adaptation on the ground. And there is also low levels of understanding and knowledge on financing processes and how to engage in such kind of processes. It's not only for the civil society, but most players on the ground, even the private sector would actually give you that kind of excuse to say we cannot get involved because there are all these challenges related to on how we want to understand, for example, how GCF is framing its policies, how to support us as players, but also to engage us directly in terms of how we can also be supporting local level adaptation interventions. So they are also building on that low levels of private sector investment on the ground. One of my colleagues, I think has already mentioned this, but this is a reality. I think in most cases, it's coming as a result of unconducive policy environment, which has also been well elaborated, but also the costs and market barriers that are there are existing in different continents. So there's, I want to also agree to one point regarding limited research and analysis on adaptation needs to determine appropriate tools, mechanisms, and technologies for specific vulnerable regions. It could be regions within the country, it could be regions within the continent, because adaptation is sector specific, but is also context specific. So it needs different kind of approaches. So building on that, the low levels of domestic financing that are there in the countries is also making it very difficult for us to accelerate adaptation. But jumping onto some of the key points on how we want to facilitate incentives to adaptation investments, especially for us to make sure that we
just have 1 more minute to close the session, but go ahead.
Thank you. So issues to do with capacity building of stakeholders to understand what adaptation processes are, the financing mechanisms that are there, but also the different options that are provided for them to help in the process of accelerating adaptation in the countries, removing barriers to accessing finance, to accelerating adaptation is also very critical and key in different countries. And also finally to leverage private finance for adaptation by addressing the gaps that are actually indicated. For example, regulatory barriers that are there, the costs and the market barriers that are there in different countries, but also capitalizing on the PPPs to ensure that we have adaptation scaled up. Thank you so much.
Thank you so much, Julius. We've basically run out of time. And please, if you've looked at the Q&A, I see that Jean-Paul has been responding to some of the questions, which is really very good. And so for the others, if you can quickly look at some of the questions. We won't really have more time for another round of questions, but this has been rich, starting from Bella, giving us a framing. What is the situation today? How do we move from where we are now to where we need to be? And then we looked at the different tools that Jean-Paul put. I've seen comments on the debt for climate swap. People are excited about it, you know, and how do we actually get this into investment decisions that people can invest in? the banks can invest in. So that's basically where this is. And what can we do to mobilize domestic resources from Africa and make sure that these resources get to the ground? So thank you very much, everyone. And I thank the UK government for this support again. And I look forward to seeing everyone at the next round of discussions, at the next dialogue. Thank you very much, everyone. And thanks for coming. Thanks for your presentations.